The news behind UnitedHealth's big drop. So, Jay, is this a time to buy the stock at a discount? It is, after all, a vast and good company.
Thanks for having me on, Tyler. Well, we have actually owned UNH in ICAP, which is our large cap dividend fund. We did trim it as it got towards 600, and that is our target. Now, with the revised guidance of $30, we have a 20 multiple. The company does grow at a higher level than the market and has an attractive dividend. So we use a PEGI ratio. So that's the PE to the growth plus the yield. And so we're using a discounted PEGI ratio to the market because of all the things you just accurately described with regard to pressure on reimbursements.
Okay, Jay, we're going to move on next to Johnson & Johnson. That stock up slightly after earnings. Angelica Peebles has those details for us. Hi, Angelica.
Hey, Contessa, that's right. J&J beating on the top and bottom lines. Now, pharma was the star of the quarter while medtech struggled. In pharma, cancer drugs, a particular bright spot. Things like multiple myeloma drugs, Darzalex and Carvykti, those both topping estimates. Immunology, another area to look at in the quarter, and that's because Stelara, a drug for some autoimmune disorders, now facing biosimilar competition in Europe, and it will also see biosimilars in the U.S. next year. J&J executives saying they can manage that decline and try to turn attention to their newer autoimmune drug, Tremfya. Then in medtech, weak economies in Asia hurting sales there. CFO Joe Wolk giving me a few examples. In Japan, J&J, the leading supplier of contacts there, and he's saying that people might refrain from ordering more expensive daily disposable contacts, or they might extend their prescription. There's also a physician strike in Korea and an anti-corruption campaign in China, and that's all weighing on sales there. Now, one other thing to keep an eye on is the shortage of IV fluid that started here after Hurricane Helene. A J&J executive on the call today saying that if that drags on, it could affect surgical procedures across J&J's portfolio. So a lot to look at there, Contessa.
Yeah, and something we were just talking with Dr. Scott Gottlieb about earlier this hour. Thank you, Angelica. Jay, what's your trade on J&J?
Thanks, Contessa. We have a hold on J&J because of our 170 target. I mean, they do have this momentum you just described on cancer drugs, but this is a gigantic company, 400 billion market cap. So we're estimating a 6% growth rate, a 3% dividend yield. So that's a 9 total return. And we believe it'll trade at the same growth plus yield that the market does. So that's a 170 or 16 times earnings. And so that's just showing only 3.5% upside. We have a small position in ICAP, but we've been trimming it in these low 60s. And we do generally prefer riskier stocks like financials, REITs, and tech, because we are more bullish about the market than most people.
All righty. Thank you very much. Let's move on to our final stock. That is Wolfspeed. We referenced it a moment ago. The stock soaring more than 20% after it secured $2.5 billion in new funding, including $750 million from the CHIPS Act. Seema Modi has the details. Hi, Seema.
Hey, Tyler, Wolfspeed CEO says this new funding will accelerate its production of silicon carbide at its plants in North Carolina and New York. This is a type of silicon used by heavily the electric vehicle industry. Now, Lowe says he really believes the new capital will help Wolfspeed better compete with China.
The Chinese are absolutely going towards electric vehicles. Something like 40% of the new car registrations in China are electric. So they are absolutely moving in that direction at full speed. And they are also trying to become completely independent of the West in everything semiconductor, silicon carbide, et cetera. So they are funding all kinds of companies in both silicon and silicon carbide. So there's no doubt about it that we face that kind of competition now.
Now, competition from China is one of the reasons Wolfspeed shares have underperformed. Weaker than expected financial performance tied to delays at its North Carolina plant also haven't helped. Shares down about 70% this year. But the stock is popping. This investment announced today, a mix of public and private capital, is seen as a vote of confidence in Wolfspeed that is sitting on a lot of debt. Keep in mind, though, short interest is high in this name, guys.
All right, thanks very much. All right, let's move into your pick on this one, Jay. Is Wolfspeed an opportunity?
Well, if you adopt our conservative methodology, this is a pretty easy call. So we would avoid Wolfspeed. It has a 31% short interest, so that really accounts for the rally. As you mentioned, they had operational issues, but more importantly, they lose money. They're not projected to turn profitable till 27. And when I was an investment banker a long time ago, we had a rule at Morgan Stanley. We didn't take any companies public that weren't profitable. We apply that rule to all of our investments and all of our funds. And I would recommend that rule for most investors, unless you have some special insight or you're on the board or for some reason want to be an amateur venture capitalist.